are now recording. Go right ahead, Ron.
All right, everybody, welcome to Triangle Blockchain Development, where we talk about blockchain technology, cryptocurrency, and financial literacy. Tonight, we have a special guest, David Stokes. David is a HECM purchase specialist. He's a retirement mortgage specialist, and he is a home equity specialist with Fairway Independent Mortgage. And he's in the Raleigh-Durham area. I'm not sure whether you're in Raleigh or whether you're in Durham. David will let you know, and I'm going to cut it short so that we can hear from David. David, go right ahead. Take it away.
Hey, good evening, everybody. Can you hear me okay?
Good evening, David.
Yes,
Good evening.
Thanks,
Yes,
David.
we can hear
Good
you.
evening.
Appreciate you. Glad you're here. Appreciate you.
So I live in Raleigh. My office that I never see is in Durham. And today I'm in Cape Carteret, North Carolina. I'm at the coast. I do tend to spend a lot of time down here since 2005. We were fortunate enough to buy a place down here, and I just love the coast. My wife stays back in Raleigh because she has to work back there as a preschool special needs teacher. But I can work anywhere. So today we're going to learn about the HECM for Purchase program. The HECM is just an acronym for Home Equity Conversion Mortgage. And just I know a lot of you have probably heard of the reverse mortgage. The reverse mortgage, its true name is Home Equity Conversion Mortgage. I think the media coined it as a reverse mortgage because everything kind of goes backwards. Instead of you paying the bank can pay you. But that loan came out. FHA introduced that loan in 1989. The purchase program, again, which I call it the HECM for Purchase, or H for P for short, came out in 2009. I started educating on that program to realtors in the Raleigh-Durham area and also down at the coast. Then I was introduced, or I was contacted by CW22, a TV station in Raleigh area. Bill LeVay or somebody, I forget his name, I don't think he's there anymore, asked me to come on to the TV show and talk about the HECM for Purchase program, which I did. It was like an hour-long show. But then from there, the North Carolina Department of Housing saw me and wanted me to do presentations for realtors in the Raleigh, actually throughout the state of North Carolina. And I started doing that in 2015 until 2018. I got throat cancer. I couldn't talk, but then I came back, but then COVID came back and nobody was doing presentations. So we haven't done any of those type presentations since 2020, roughly. They stopped doing the presentations for that. But now I do them on my own. I do them for realtors. I do them for financial planners, insurance agents, because there's so much more to the purchase program than being able to buy a house with this loan that's specifically for older adults. And the program or the loan is for older adults that are relocating or downsizing. In some cases, they're upsizing to their primary home. The program allows buyers to use some of their cash. So the majority of buyers are, again, they've sold their other house, they have some money in their hand, and it allows buyers to leverage those funds to make a one-time payment of roughly 45 to 65% of the purchase price. Then the lender will lend the rest of the funds to buy the house. With the program, it's just like the reverse mortgage. No monthly payments are required. The buyer must have enough cash with an asset, usually again from the sale of their house, to make that one-time payment. The buyers also their requirements are to pay their property taxes, pay their homeowners insurance, maintain the house, pay their HOA fees, and live in it as their primary residence. That doesn't preclude them from not having another house. I have clients that'll have 2 or 3 homes. I got one client has his primary house in North Carolina. He has a house in Maryland where his grandkids are. And then he has a third house in Florida where he goes during the winter time. So it's a program that doesn't preclude you from owning other properties. And actually, some of my clients, because they're able to leverage some of the funds they got from a previous sale to buy their primary house, they have this money left over. It's helped them to buy a secondary home or helped them to finance a secondary home. And Arad, do you want me to take questions during this or at the end?
Yeah, we're going to let you present, David. And then once you present, then we'll open it up for questions and Blair will moderate. And we have a format where, we'll raise our hands and we can see who's first, second, third, and all that. And so Blair take care of that. So,
okay, good. The reverse mortgage is an FHA program. The maximum borrowing limit is $1,089,300. But that doesn't, I've had clients that bought $1.2 million homes with the program. That's just the maximum lending limit. So with those type of clients, they have to bring a little extra because they're going above the lending limit of the program. The program's had a few amendments, positive ways since it was introduced. One of them being with the program, you have to be a minimum of 62 to get the loan. Or you could be married to somebody 62. They use the age of the youngest person to determine how much you can qualify for. So in that case, where you have somebody that's not 62, they're not on the loan. Prior to 2014, if the older spouse passed away, the loan became due. Now there's safety features where if the older spouse passes away and that other person was under 62, they don't need to repay the loan or sell the house and get out. They can stay in the house. They just got to meet the same requirements as before. Pay your property taxes, pay your homeowner's insurance, maintain the house, and live there as a primary residence. So nothing. So there were some positive changes with that change because that was a big negative with the program. The loan also is a non-recourse loan. Meaning the heirs, when they inherit the house, they will not owe more than what the home can appraise for at the time of repayment. So get your mind around that. So if the house appraises at $600,000, but the loan has built up to $400,000, they're only going to owe $400,000. But if somehow the house gets underwater, and the loan balance is $600,000, but it appraises at $400,000. The heirs can actually, if they want to keep the house, they can pay 95% of that appraised value in order to keep the house. That was a change that was implemented as well. The borrowers or the home buyers also have to meet with a HUD counselor. It's one of the protections because once you reach my age and you're 62 and older, you get some protections, and they have to meet with a HUD counselor to make sure they understand the program, to make sure lenders are not deceiving them, because maybe if they don't have their full faculties, some of these lenders can still pursue and move forward with the loan when they shouldn't. And the HUD counselor is also and should be looking for the client's cognitive abilities as a protection. As I mentioned, there's no payments required, just like a reverse mortgage, but you can pay on the reverse mortgage or the HECM for Purchase program. You can make payments at any time, as small or as large as you want. Let's see what else. I'm trying to think. So when they do make payments to the loan, this is where it gets kind of creative. The loan, you will make payments and it'll pay interest, which of course, if you're making monthly payments or payments just every so often, those are not going to be deductible. And I'm not here to get tax advice, but you'll get an interest payment statement, but we can't pay interest. We can't deduct interest right now. But what happens is that when you make a payment to the purchase loan, it also goes over into a line of credit that's in the background. It's not funded. So when you make payments, you're funding your own line of credit because you're putting equity back into your house, basically. And then the other unique thing about that, and if you're taking notes, note this, because the line of credit has a growth rate to it. And today that line of credit is growing at 7.58%. So I always tell my clients, if you have the ability and have the cash flow and you want to, make payments to your HECM for purchase loan, because where else are you going to get 7.5% tax-free? Because it's tax-free compounding interest on that. And then when you take the money out of your line of credit, if you take the money out of your line of credit, that's also tax-free. Again, because that's from IRS tax code 7202, where you're taking it from a loan, so it's not taxable funds. So that's a pretty unique feature that the program has that a 30-year mortgage does not have. Nobody, unlike a traditional HELOC, home equity line of credit program, that can be reduced because it was done in 2008. It was done recently, and they can take away the HELOC loan if you have one. The home equity line of credit loan cannot be taken away and cannot be reduced, no matter what happens to your house value, or no matter what happens to your loan to the house value. Even if your loan becomes larger than the value of your home, they cannot take away a line of credit if you have built up that line of credit. As I mentioned before, you must be 62. You must be buying your primary residence, and there are minimum credit and income requirements. They don't look at credit scores with this program, mainly because payments are not required. So they look at your past 2-year history, that you've paid your credit bills on time. And they also look at, for qualification purposes, they look at your past 2 years on every home that you own, that you've paid your property taxes, homeowners insurance, and HO fees on time for the past 2 years. The income qualification is a little different than the 30-year mortgage. The 30-year mortgage typically has a debt to income rate type ratio. This does not. The HECM purchase program has a residual income qualification. So what that means is that you have to have enough monthly income to pay your property taxes, homeowners insurance, HOA fee, and maintain your house. And then if you have credit card debt that you're paying monthly on, that's included in those monthly debts. If you have a car payment or any type of loan payment, they add up all those payments, the taxes, insurance, HOA, property taxes, maintenance, and your other credit, and they subtract it from your monthly income. And you have to have minimum residual income for a single person of roughly $530 a month. For a couple, roughly about $900 a month. And so then also if you have a daughter living with you or son, because I had a couple, they were in their 80s. Their daughter was their caretaker. She was 64. We did the loan on all 3 of them. Their income qualifications was a little bit higher. And that will also vary according to what part of the country you're located in. So for 3 people, the residual income qualification is like $1,200, $1,300 a month. So which usually isn't hard to meet because most people get the Social Security checked. And then with that couple whose daughter was living with them, she also had a job. So they qualified quite easily for the program. The type of properties that qualify for the program, probably 90% of them are single family residences, and they all will basically qualify. Now, if there's some issues when you buy the house, there's some repair issues, or they always have to be completed or repaired before the lender will close on that loan. Other types of properties, you can buy a 2 to 4 unit residential property. I like this concept because somebody can buy a duplex or a 4-unit property, live in one of the units, and rent out the other units. So you bought a property where there's no mortgage payment required, and you're getting rental income from however many other units that you own. Townhomes qualify. Manufactured homes, trailers qualify, but there's a lot more requirements, FHA requirements for mobile homes. I won't go into details, but a couple of them are: they have to be on a permanent foundation. They have to have the wheels taken off of it. So there's a lot more that needs to be done with a manufactured homes. Modular homes qualify. Townhomes, if I didn't mention that, condos qualify, but they have to be a FHA approved condo development. Condos, and actually when they're not approved condo developments, FHA approved, we have a program that we do it for free. A lot of companies will charge for that. The downside is that a lot of condo associations don't want to give us the paperwork or participate in helping us to get the condo, to get the association FHA approved, because we can do it, but we need their help to get the documentation. And that usually, if they're in it, and if they participate and help us with that, it takes about 90 to 120 days. So as I mentioned, the percentages, how much somebody's going to have to bring. So somebody my age right now this changes because how much you're going to be able to, how much you have to bring to buy the house is going to depend on four things. It's going to depend on the age of the youngest buyer. It's going to depend, of course, on the purchase price. It's going to depend on the interest rates of the day. So the higher the interest rates, the more people are going to have to bring. The lower the interest rates, the less they have to bring. The younger they are, the more they have to bring. The older they are, the less they have to bring. It's not based on gender, even though you females live longer than us guys. Interesting enough, it's not based on gender. It's strictly based on age, and it's based on longevity. So the reason, as you can probably think, that why somebody 62 has to bring more money than an 82-year-old, they're going to live much longer, and they want the FHA and HUD wants there to be more equity in the house. So then when the home buyers pass away, the heirs are going to have some equity left in their house. But the way HUD has it set up now, it would have to be we'd have to have a couple 2008 debacles happen in somebody's lifetime for there to be no equity left in the house. Or we go to war with China, interest rates skyrocket, and that will eat away at your equity too. But as I mentioned, I highly recommend to clients that they make payments into their loan, because again, it goes into that line of credit that's waiting in the background to be filled up when you do make payments. One way that I'm going to use the program is a very unique way. And again, I'm not giving you tax advice. I'm just giving you a strategy that, of course, involves the taxes. So I currently own a house. It has a mortgage on it. And then I'm going to, with the purchase program, you can then make payments, but you can save up your payments. This is the only loan program where you can stack interest, mortgage interest, that is. So I'm going to stack interest for about 8 years, and then I'm going to make an $80,000 payment is my plan. If I can save up that money during that time and I don't go on a bunch of trips, I'm going to save up that money, and then I'm going to get a large tax deduction. With that tax deduction, what I'm going to do, if I can do that process, then I'm going to do an IRA conversion. I'm going to take money from my traditional IRA that's taxable, and then I'm going to do a Roth conversion and put that IRA money into a Roth IRA, which is a taxable event. But because I made this large interest payment on my loan, I'm going to get a tax deduction, and that's going to hopefully match the taxes I would have to pay on that IRA money. So it's just a unique program made for people that are in retirement or going into retirement. And that's just one of the tax strategies that I talk to people about if they're interested. And again, also just a reminder, when I made that large $80,000 payment, unlike a 30-year mortgage where you lose access to that cash, with the HECM for Purchase program, you make a payment in there, it goes in your line of credit, and today it's growing at 7.5% to 8%, and you have access to that money at any time. So it's a pretty unique feature. That's the basics about the program. It's not a lot to it. It's very similar to a 30-year mortgage, except for it has all these bells and whistles. It's the same as a loan. The bank does not own the house. The buyers own the house. The bank is just a lien against the property. So it's very similar to a 30-year mortgage, except for it just has all these bells and whistles. You don't have to pay cash for that $600,000 house. You know, I have a lot of the clients recently have been buying $600,000 to $800,000 homes, and the one couple, he was 64. He has to pay about $580,000, $580,000 versus paying cash, which he actually has the cash to pay for the $800,000 house. But his thought was, why should I pay for $800,000 when I don't have to? My kids don't want the house. They just want it whenever remaining equity is left in the house. And that's what most of the clients always say. They're like, well, the kids don't want the house. They just want the equity in the house, which is typically the case with the HECM for Purchase program, because it's not the house the kids grew up in. The parents have usually relocated and used the program to buy their next primary house. That's about it, Rod. That's all I got for you tonight. I think it's not a difficult program to talk about. It's just complicated because it's not what we grew up with. So it's hard initially to wrap your mind around the ability to buy a house for roughly 45 to 65% of the purchase price and not have to make a mortgage payment.
Yeah, absolutely. Most people have a hard time wrapping their head around it. David and I are actually working with a lady down here who was actually, she's a widow. She lost her husband about a year ago, and she has a home. It's like over 3,000 square feet, and she does not want to have that type of maintenance. And it's like a half an acre, or somewhere between a quarter and a half. So she doesn't want to have that maintenance. And she was thinking that she would buy a home that was $250,000. That's what she had allotted cash. And because she didn't want to use all her cash, of course. And so when she was talking to me, I told her about the HECM program. And I asked her, I said, are your children, do they want the home? And she said, no. And so I gave her the information, and she was blown away. And she was like, get out of here. I said, no, I'm serious. And so she's looking at a house now that costs $400,000 because she can put $200,000. And David will give you the correct amounts. She's 65, so it changes from 62 up to, I guess, 65, 70. David, you'll explain that to him. And but she literally can buy now a $400,000 house in a neighborhood she never thought she could be in. And so we're gonna, and she was excited to talk to David. And so what we're gonna do is open up the floor. Blair will moderate.
Hey,
I know
Rod.
you get questions.
Hey, Rod,
Yeah,
I do have two more stories that will really help to
sure.
emphasize the program. So so back when the program first came out, I wrote an article in Relocation Guide magazine, and this couple, they're sitting in this real estate office in Chapel Hill, waiting for the realtor to come out, and they happened to be reading my article. This couple had about 1.6 million in assets, but then they also had 250,000 set aside to buy a house for cash. That's because they did not want a mortgage payment. They're in retirement. They're not working anymore. So they're reading my article, and they asked the realtor when she came out, do you know about this? And she was like, I know nothing about it. So they gave me a call on Sunday night. I think it was 9 o'clock. I think I was brushing my teeth, getting ready to go to bed. So they called me up. I gave them a 10-minute, real quick synopsis of it. The next day they called me up, and I ran some numbers for them, and they ended up making a purchase offer on a $560,000 house, because they were able to leverage that. Back then you could leverage a lot more to buy a much bigger house, and they, instead of buying the house they could afford, they bought the house that they wanted. He's like, I want my wife to have this house. And it was just a great story how they would have, if they hadn't come across that article. And that's why I try to educate the realtors on it, because they're the first line. You're the first line where customers go. They usually don't come to the lender first. They go to the realtors first. and then the realtors will send them on. And she had no clue about the program. So that was a unique story, a really nice story. My dad also used the program. I forgot to tell you about my dad. So I grew up in the Annapolis, Maryland area. I moved to North Carolina about 31 years ago, started an insurance company. And then my mom passed away 13 years ago, and my dad sold his house, cleared 12 years ago. My dad sold his house, cleared 200,000 after his loan. He actually had a reverse mortgage. His reverse mortgage was paid back. He came to North Carolina with 200,000. He was 78, I think, at the time, and he found a $230,000 house, single story, somewhat easy to maintain. And based on his age, the interest rates at the time, which were much lower, and that purchase price, he had to make a one-time payment of $85,000. So he had 115,000 left over. And at this point, now I know I'm my dad's caretaker. He's moved away from my other brothers and sisters. Mom's not around. So with that 115, I used 100,000 to buy a long-term care annuity. This annuity tripled in value immediately. That's how this type of annuity works. So now he has 300,000 in long-term care coverage, a house that he never needs to make a payment on. And if he never uses the long-term care coverage, he never loses that initial $100,000 investment. So when I was teaching the class for the North Carolina Department of Housing, I would tell the realtors about this, because this Peckham for Purchase program is so much more for these seniors than buying their next primary house. It opens a world to them that they're able to take care of retirement goals and plans that they never thought they could. And they could also, my dad could have also put that into an income annuity and helped with his financial longevity. So it's just a great program because of all the things it allows customers to do besides just buy a house and not have a mortgage payment. So it's pretty cool. So those are the two stories I have. Actually, there was another one. It was a lady in Kentucky that I helped. She had a $110,000 home, but it had two stories. It actually had one story and a basement. And her washer and dryer were in her basement. And she was concerned about, now she's up in her 78 years old, about walking up and down the steps. Her kids were concerned that she had to walk up and down the steps to do the laundry. So she sold her house, cleared, it was paid for, so she cleared 120,000 and minus the realtor fees. And she found just another $120,000 house, but it was single story. Everything was on the first floor, washer and dryer. And she didn't have to use all her money to buy that next house. So not only did she buy a house that she felt safe in, she had an extra, probably, I think it was like 45,000 or more in cash that she never had before. I mean, that's on the opposite end of what a lot of my clients would they buy. But it was just a great story that now she feels safe. She has extra cash in her pocket and no mortgage payment for as long as she's living in the house. So
awesome.
Yeah.
Three great stories. We're gonna go ahead and open it up. And thanks a lot, David. Appreciate you sharing all that information. We're gonna open this up. And for those who are new to Google Meet, there is a hand that is the third from the right. So going from right to left, you should see a hand. So if you have a question, just click on the hand. Make sure you don't hit the arrow, because if you hit the arrow, that means you're presenting. And so what we'll do is there is a queue, and I can see the queue, and Blair can see the queue, and Blair will moderate, and I'll keep my eye on the queue and to keep the conversation going. And David will answer your questions. So go right ahead and take it away, Blair. Thanks again, David.
You're welcome.
Thank you very much, Rod. Thank you very much, Dave. That was awesome. You answered a lot of my questions. Thank you.
You're welcome.
Marva has her hand raised. Marva, please go ahead with your question for David.
Hi, David.
Marva.
I was trying to figure out, is there two different types of programs? Was there one where you could put cash down, like say if the house was 200,000, you put $100,000 down and you don't have to pay anything else? And was there one that you actually could get a mortgage for? I was kind of confused a little there.
So yeah, I'll describe it real fast. So the HECM for Purchase program is where you're going to be buying your next primary home for a percentage of the purchase price, roughly 45 to 65% of the purchase price of that purchase price, and it's going to be based on your age, how much you have to bring. It's going to be based on your age, the purchase price, of course, and the interest rates at the time. So that's the program where you have to bring your one-time payment, asset payment. Can't when you buy your home with this program, that has to be from an asset. Can't be from borrowed funds. Because I had one prospect, they were short about 20,000, and they wanted to take 20,000 out in credit card loans to buy the house, and it's not allowed. It has to be from an asset. So that's where you're bringing money to buy the house. And I wasn't sure what the other program that you mentioned.
I was wondering if it was a program where you put, like, if the house was 200,000 and you have 100,000 and then you don't have a mortgage at all.
Okay. Well, again,
That's
yeah. So you're talking about really the same thing. So if you, that's what I will do for some clients. They'll have sold their house and they'll say, "Well, David, I got 100,000 in my pocket. I'm this age. How much house can I buy?" And so with that, I'll work it up backwards back into what they can buy for $100,000 if they're age 62 or 72 or 82, because it's going to be different for every age. Lots of times the clients are coming to me, they're like, "I just found a 500,000 or $400,000 house. I'm 62. How much do I have to pay down? What's my one-time payment?" So you're talking about the same thing. Just I would just need to work it backwards to determine how much you can buy with the amount of cash you have on hand. Did that answer your question?
Yes, thank you.
You're welcome.
Thank you, Marva, for your question. Anybody else have a question for David while we have him here? Anybody have a question? Monroe, go ahead with your question, sir.
Hey, how's it going, David?
Hey, Monroe. Good evening.
Look, my question is, okay, I was driving, I was listening, but now did you say, like, say, I'll be 62 this year, my wife will be 62 next year, and the house is close to being paid for. But if we sold our house, how long does it take from the time we sell the house to get everything approved and move into the next house?
Oh, excellent question. And I probably should have touched on that. So I always tell clients, before you even sell your house, so of course some clients have already moved and they've sold their house, but I have a pre-approval process. That takes as long as it takes. It takes 3 days once I receive the documents I request from the clients. And the pre-approval documents, it's not a big list. It's pretty easy. I know the 30-year mortgages, they've bumped up on documentation these days, it seems like, and it seems like it's harder to get loans on the 30-year mortgages, but the HECM for Purchase is probably the easiest loan to get the loan. So first we do a pre-approval process before you even move out of your house. And again, that will, once you give me the documentation, I'll have your pre-approval letter in 3 days. And then you go house hunting. And then once you find a house and put an offer on the house, we get the purchase contract. We do the application after I receive the purchase contract, and then we're closing in 30 days.
No, 30 days, that's pretty quick.
Yeah, and I've had loans close in 17 days when it was, and I can never promise 17 days, but it was a rush situation. The loan fell through with some other lender. They came to me and I was like, "Look, we need to rush this one." And we put a rush on it and we got it done in 17 days, which is unheard of in the HECM for Purchase / reverse mortgage business. Companies just don't do it. I worked for AAG, approached me back in 2011, I think it was, to come work for them because they knew I was really good at this purchase program. I had a good reputation. And I was like, but can you close my loans in 30 days? Because realtors won't work with me if I can't get a loan closed in roughly 30 days. And they're like, oh yeah, we can get it done. It took them 70 days. I worked for them for like 2 months because they just could not close loans. I mean, they're a good company, but they just can't close loans, as quick as, especially for the purchase side of the business. You got to be able to close loans in 30 days, roughly 30 days. Thanks for that
Monroe.
question, Monroe.
Yeah, go ahead, Monroe. That answers your question.
Well, that answered the question. I was just, I was curious about that. And now, how do we find out, say, what percentage that we would have to put down on the house
Yep.
based on our ages?
Yeah. You just, Ron, I'll give you my contact information. I would just need your birth dates, for you and your wife. And then I would need your approximate purchase price, or if you know the purchase price of a house. I know I want to buy a $600,000 house. You'll just tell me that, and I'll give you an answer in 2 minutes.
Well, that's good. Well, I'll get you information from Rod.
Okay.
Hey, actually, I already put the information in the chat box.
In the
So
chat
if you need
window.
David's information, it's in the chat room. Also, Dave, just give them an idea. I know you can't be exact. I mean, I know that there are some, some other factors involved, but just give them an idea. Like if you're 62, is it, 40%? If you're 65, it's around 50%. And I know it changes for each individual, but they're just trying to get an idea. Like if they have, they see a $300,000 house. Do they just need, somewhere around 150,000? And of course, nobody's holding it to you because we know each individual situation is going to be different.
Yeah, no, I don't mind at all. And of course, because I had a PowerPoint presentation that has these numbers in it, but it's based on interest rates when they were 5.5%.
Right.
And it's a lot different now. So right now, I know wage 62. So somebody at 8, because I'm 62. Somebody 62 is going to have to bring approximately, bear with me here, about 62% of the purchase price.
Okay.
Somebody 72 is going to have to bring roughly 58% of the purchase price. Somebody 75, did I just say 75, 60, 72? Somebody 82 is going to be getting closer to the 50% range.
Gotcha.
So it changes just just a little bit by one year is not going to make a big difference. But and again, it's so close. 45 to 65% of the purchase price. Once you get to like 90, it doesn't get any better if you're 95. It's kind of slows down on that on the break that you get to buy the house.
So to give you an idea, if somebody's somewhere between 62 and 65, 62 is about 62%, 65 will be probably about the same, a little bit less.
It's gonna be right around the same, maybe a point less.
Gotcha.
Yeah.
So it's gone up. It's gone up. A little bit from when it was just 50%. So it's around 60. That 60% mark, 60, 62%. Okay, appreciate it.
And that's not to say that things won't go back, because I know the industry, the HECM purchase industry, reverse mortgage industry, is constantly bugging HUD to reevaluate these percentages again, because the housing market is stabilized. The economy is doing well, and housing. They were freaking out. HUD was, because home prices had deflated so much. But and also they were worried about the mortgage insurance fund. That is doing great. The housing market's doing great. I mean, there's a shortage of homes, so they're in no time soon are these home prices going to drop like they did in 2008, unless we have some type of catastrophe or war or something. So hopefully the HUD will reconsider and start increasing the percentages of what people qualify for. Because yeah, I mean, I'm 62, and I was disappointed when I ran the numbers on my own age, and I'm not going to get as much as I thought I would. Because again, I just want it for the line of credit, for that line of credit to grow, grow, grow. Because I'm going to be using the program hopefully down. I'm going to use it for an emergency fund. Because right now I have the cash in the bank to pay off the loan, but my loan is 3.5%. I'm not going to pay off that. But I want to do the loan because of the emergency fund in the line of credit that I'm going to build up. And then I can put that money in the bank to work, because right now it's lazy money. I call it lazy money. It's just getting 0.5% interest in the bank, sitting in the bank. I also want to build up my line of credit for if I need in-home long-term care. I mean, the percentages are high for people once we get in our mid to late 60s, 70s, and 80s, that I will need, or my wife will need, some type of long-term care, in-home long-term care coverage. I don't have long-term care insurance, so I want to build up that line of credit and have it grow at 7.5%. So if I need it, I can draw on my line of credit. And then the last thing I also want to use it for is if my IRA money does not do well, or the economy does do bad, and I need money, income, when I'm 80, 85 years old, or 72, and then I can draw from that line of credit tax-free for additional funds. I could also turn in, I didn't mention this, but if your line of credit builds up large enough, you can turn that line of credit into tax-free lifetime distributions. So if I build that line of credit up to a couple 100,000, and at age 75, I want to turn that 200,000 into lifetime income, I could turn it in probably into about $15,000 to $18,000 tax-free money for the rest of my life, annually, that is. So it's so many different ways to use the program. Yeah, so it's unique, unlike unlike the 30-year mortgage, where you don't have all these bells and whistles.
Interesting.
Thank you.
It really is. And then I love talking about the program. My wife, I think she finally understands it after 20 years. I'm not sure, but and then, when the Department of Housing, North Carolina Department of Housing, asked me to talk about it, she was like, "Are you going to do it?" And she was poking fun at me, because she knew I was going to do it, because I love talking about the program, because nobody talks about it. Nobody understands it, and there's just not enough information out there. And then the information that is out there is usually wrong. They usually will say, well, at the end of the loan, the bank gets the house. The bank doesn't get the house. It's just like a 30-year mortgage. There's some mortgage left that if the kids want the house, they got to pay for the mortgage. If they don't want it, they sell it, pays back the mortgage, and they get the rest of the equity. So I'm always combating the misinformation, that's out there.
That was a question I was going to ask you myself. Actually, you just answered that one. Thank you.
Which one was it? What were you going to say, Butterfield?
About the mortgage not being paid at
Oh,
the.
yeah.
That's what I was going to ask.
Oh, yeah. And so I had a unique situation. I had a mother. She had a daughter, didn't live with her. The mom used the program, and unfortunately for her, she died a year later. There was a ton of equity. There was probably 100,000 in equity left in the house. The daughter said, "I don't want the house, David." I was like, all you got to do is give it to a realtor. Let them sell it. You'll cash in 100,000 minus the realtor fees. She said to me again, "I don't want the house." I was like, all right.
Wow.
If you don't want the house, contact the servicing company, tell them you don't want it, and you'll sign a quick claim deed and sign it over to them. I don't know what they do with it once they get it, but all she had to do was give it to a realtor. So, and the opposite's true. If there is no equity left, again, that's going to be really hard to do. But if there's no equity left and the kids inherit it, I tell the kids, we got a couple options here. First, if you don't want it, don't want to deal with it, because you still have to pay if you inherit it, you got to pay your property taxes, homeowners insurance until you sell it. Just let the servicing company know that you don't want it, and you'll just sign it over to them. I said, but another option is that if you have the ability and want to buy the house or finance the house, well, you get with your tax advisor, because if you put the house and title it to your name before you pay it off, when you pay off that all that interest, you're going to get a really large tax deduction, as far as I understand. And that'll get people's attention too. I'm like, well, wait a minute. I was like, but talk with your tax advisor, make sure that what you're doing is the right way. But I'm pretty sure if they put that house in the name and they want to, keep it and then get their own loan or use their own cash to pay off, the HECM loan that their parents left them, they will get a tax deduction. And I could be wrong, but again, I'm not giving tax advice, but that's another strategy. And that's for people that have a lot more money than me. But
Well,
it's
the
a
question
strategy
though,
that's out there.
Dave, do the people who inherit the house, do they take an income gain? Do they get it?
I get you. I get you. Good question. So no, if there's like a line of credit where the owners were getting their mom and dad were getting income from that goes away once they die. The kids
I
will
see.
only inherit the house and whatever equity is left in it.
Gotcha. Okay. All right. Anybody else? Raise your hand. We have a question for Dave while we got him. Go ahead, Mary. Go ahead with your question, Mary.
Yes, thank you. And I appreciate the information, David.
You're very welcome, Mary.
My question was, what happens whenever a person has to go into, let's say, an assisted living facility and can no longer stay in the house? I know you said the payments weren't due as long as the person was in the house, but if they left under those circumstances, what would be the outcome?
Great question, and thank you for that, because I should have covered that. So the loan becomes due when the last person leaves the house. So if it's a couple and one goes into a nursing home, nothing changes for the person that's still living in the house. They don't have to make payments. They just do their normal requirements, pay the property taxes, homeowners insurance, HOA if they have one, and maintain the house. Now, if say they unique in a situation where both people have to go into the assisted living. If they're in the assisted living for a year, the loan becomes due because it's no longer their primary residence. It doesn't become due the next day. The servicing company gives them 6 months to either sell the house or refinance the house if the kids are helping them, or if the parents, the ones that occupied the house, maybe they still have their faculties. And because I just had a client move into Springmore. I did a loan for them. They used the purchase program and bought a house in Wake Forest. And then they just sold the house and they voluntarily moved into Springmore. But if they hadn't sold the house already, they would have 6 months to sell it. And then if they weren't able to sell in that 6 months, I always tell them you request another three extension, and they give you a 3-month extension. If you don't sell it in that 3 months, ask for another extension, and they'll give you another 3 months extension, meaning they'll give you up to a year to either refinance the house or sell the house to pay back the mortgage, so it doesn't get foreclosed on. So does that answer the assisted living question?
Yes, thank you.
Yeah, so the loan is also due when if they decide to sell. So they sold the house and they moved to Florida, the loan becomes due. The loan becomes due if one's in assisted living, and then the person that stays behind, if they pass away, then the loan's going to become due. And in the parameters I just mentioned, they're going to give you 6 months, and then they'll give you 3-month extensions. And then, so you sell, you move out, you go into assisted living. The last way it's done, the last way when the loan is due is when you're living in the house and you've turned 150 years old. So that's when the loan becomes due, is when you're 150, the youngest person is 150 years old, the loan becomes due. So it's designed that way, obviously, because the loan is designed for it to be your forever home, your forever primary home. So they want to make it where it never really becomes due as long as you're living in there or you pass away. So, good question, Mary. Thank you for that too.
All right. Thank you, Mary, for your question. Ojo has his hand raised. Go ahead, Ojo.
I have a thought. For a first-time home buyer, is it basically the same as that kind of program, or is it different?
So no, it's the same for a first-time home buyer. With this program, they still have to be 62, of course, or older, or married to somebody 62 years old.
Thank you.
Yeah. So I did, Ojo, I did have that scenario. The couple never owned a home, and it was also very unique because he was 72 and she was 59. Of course, we based the amount they had to bring on her age because she was the youngest. Heaven forbid, and he was the only one on the loan. So what's unique about it again is that if he passes away or has to go into assisted living, nothing changes for her being the younger spouse under 62. She just would continue to make the homeowners insurance payments, property taxes, pay the HOA and maintain the house and live there as their primary residence. But yeah, it's no different if it's their first home or their seventh home. Good question.
Thank you.
Ojo, thank you for your question. Anybody else have a question for Dave while we got him here?
And as I
Okay.
tell everybody, there's no silly questions
No
because
silly
the program
questions.
is so different, so unique.
Yeah, it really is. It is. It is. Ojo, unless you have another question, you can lower your hand. There we go. Thank you, Ojo. Anybody else have a question for Mr. David Stokes? Aha. R2, go ahead with your question, please.
All right. Hey, David, earlier you had mentioned there are some folks that have multiple homes. How does that work? I mean, I know it has to be your primary residence, this particular purchase. Is that correct?
Correct. Yeah, the couple I had like, oh, good golly, between 5 and 10 clients. They have multiple homes, but they're using this program to buy their primary house. So the one couple actually moved from Maryland and kept that house because it was close to their grandkids. And then they came to North Carolina. And again, they only had, they had a good amount of money. So, but they didn't have to use all that money to buy the house in North Carolina, which then allowed them to buy a smaller condo in Florida. So yeah, it was a great situation for them because now, I don't know why they want a place in Florida. They got a place in North Carolina, but
Yeah.
but it was just, they were like, no, we have friends down. I think it was because they had friends down there. They like going down there when it gets. They just didn't like the cold whatsoever. So when it gets a little chilly here in North Carolina, they go to Florida for that week, for that month or whatever. But then they kept their house in Maryland. So when they went up there, they didn't have to stay with family. They go up there and see their grandkids and stay at their house up there. But they did have to qualify. They had to qualify based on the property taxes, homeowners insurance, maintenance cost, and HOA fees for their Maryland house and their North Carolina house that they were buying. They didn't own the Florida house at the time. They bought that shortly after they closed on the house in Maryland. But they do have to qualify income-wise based on every property that they own. And they have to have had paid their property taxes, homeowners insurance, and HOA fees on time for the past 2 years. But even if they hadn't, doesn't disqualify them. I had a gentleman move down from New Jersey to Surf City, North Carolina. He had a little over 400,000 from the sale of his New Jersey house, and he found a $380,000 house down in Surf City that he back then he paid roughly 50% on, but he had been late on his property taxes up in New Jersey like 5 times. This is going to require an escrow account, a permanent escrow account. And it's unique with the purchase program than a 30-year mortgage, where a 30-year mortgage, they just keep roughly a little over 1 year of escrows in the account to pay your taxes and insurance for you. With this program, they calculate how much he needs in his escrow account based on his life expectancy. So his life expectancy was, and they use Social Security's chart for life expectancy age. So he was 62. His life expectancy was 84. That was 22 years of escrow accounts he had to keep in there, which added up to, I think, over $100,000. But he had,
wow.
but he had the money from the sale of the other house.
Right.
And he really liked the idea, because he's like, well, now I don't have a mortgage payment. I don't have a property tax payment. I don't have a homeowner's insurance payment. So it's some people like it, some people don't. Some people just don't have the funds to fund the escrow account if they've been late on their taxes or insurance, and there's not a good reason. Because I've had clients that were late, but they had a valid reason. It was like me. I went through cancer, and I didn't work for a number of months. That would have been probably a valid reason. They would have waived the escrow account, the mandatory escrow account. But he didn't have a good reason. He was just late.
Right.
So,
one quick question, because I see Mel has her hand raised, but just real quick, can you explain to the group? I know at one point when you were 65, it was around the 50% mark
right.
that you needed to have. Was that based on increased interest rates? Is that what caused it? Or can you kind of give an explanation? Or did the program change? Or
yeah, it was a little bit interest rates. Not as much as HUD lowered how much people could qualify for, because they were getting complaints when we were lending 50% to a 60-year-old, back 15 years ago. It could happen where there would be no equity left for the heirs at the end. And it wasn't really a problem for HUD per se, or for the lender, but it was just these heirs. So many people complained that, and not really so many people. It was just the small amount of people made a big squeaky wheel about it, that they weren't getting their inheritance. Not that their parents promised them the equity from the house, but there was just none left. And HUD's like, okay, well, we'll change the percentages on how much people can qualify for, which will leave more equity in the house for heirs down the road. I don't know. I thought it was a little knee-jerk reaction, but they picked away at it for like 3 or 4 times over a 10, like it seemed like a 10-year period. Every 2 years or 3 years, sometimes it'd be 2 years, sometimes it'd be 3 years, they would lower the amount that somebody qualified for. They call that in the business, I was going to say the principal limit is what you qualify for. That's the percentage would be called the principal limit. So they pecked away at the principal limit every so often. And so, but now if rates were back where they were then, so like I qualify for about 38% of if I would buy a house, I'd have to bring 62%. If the rates were back where they were then, I'd have to probably bring about 58%. So it would lower, if the rates were lower, like they were back then, it would lower how much I would have to bring. But again, we are the industry. I say we, the industry is seems like constantly bugging HUD to reevaluate the amount that they lend these days. But even so, what I show people, I have the software to show them. If you buy a house today and finance that house with a 7% interest rate, you're going to end up spending 2.5 to 3 times that purchase price versus 45 to 65% of a one-time payment of 45 to 65%.
Right.
Once they see the numbers, it helps them, because you say that, but when you see it on paper, or I have software that does it, it really brings the value of the program home. That you're going to spend so much less money in retirement, and more money. That means more money for you in retirement than if you did a regular refinancing, or again, even paid cash for it. Again, I have clients that bought an $800,000 house. They had the cash, but because of their age and leveraging the cash they had with this program, they ended up making a one-time payment. I think it was 560 or 580,000. They're like, it's a no-brainer.
Great. Appreciate it. Thank you.
You're welcome.
Wow. Anybody else? Mel, your hand is raised. Oh, she took it down.
Thanks, David, for making time to meet with our group this evening. And the information you're sharing is very valuable. Question: can this program, and I apologize if you spoke to this earlier because I joined late.
It's okay.
As for that, can this program be leveraged with a parent and a child, or is it solely the parent?
Yes, it can be leveraged with the parent and the child. So again, that's where it will get a little tricky with that, because I mentioned that, well, before you joined, I actually had a client. The parents were in their 80s and the daughter was 64. So all three of them were on the loan. So if mom and dad, and they bought the house, with all three of them, if mom and dad died first, the 64-year-old stayed in the house, never had to make a payment, never had to repay the loan. But how much they had to bring, it was based on the younger person, meaning it was based on the daughter's age. So, and then when it gets to a situation where if the daughter is under 62, then she will not be part of the loan. She will not have the protections that the loan has. So if the mom died, she would be the one on the loan. If she died, the loan would become due. It's only it only protects a younger person if they're married to the older person. So I've also had where it was couples that were life partners. They never got married. One was 62 and one was 60. The one that was 60 is not protected. They still did the loan, and I think later on they refinanced to get this. The one that was 62 now was 60 is now 62. They got her on the loan that way by refinancing from the same loan, just then getting her on the loan. She was already on the title, just getting her on the loan. So the only time a younger person's truly protected without refinancing is if they're married to the older borrower.
All right. That answer you, Mel?
Yes, he did.
Awesome. All right. Anybody else got any questions for Dave while we got him? Anybody? We're approaching an hour mark. Anybody, any questions? David Stokes, HECM program. What about you folks down there in Florida?
Sunny Florida.
No questions from Florida?
Their question is, how do we get homeowners insurance?
Right.
That's a good question.
Good question. Good question.
Blair, since we don't have any questions, we can go on and wrap it up. And David, appreciate you coming out. And Blair, you can take us out. And you had any final words, David, that you wanted to say? And if not, then Blair can take us out.
Yeah, I mean, you all have my contact information. Again, keep the questions coming. And if you want some brochures on it, I'd be more than happy to email you a digital brochure in the program to read up on. But it's again, the brochures are always basic information. They're not going to go into a lot of the details that I went into or some of the strategies on how you can use the program. They just don't do that.
Right.
So it's just going to give you the basic information. But keep your questions coming. I don't mind even answering the same question 10 times because again, a lot of the clients I work with, they're going to be up in their 70s and some 80s, and they'll ask me the same question 10 times, and I don't mind because I'm patient and I love answering their questions. Make sure they understand. It's so important for them to make sure they understand the program.
Absolutely.
So thanks for your time too, guys. Thanks for having me on. I appreciate it.
Absolutely, Dave. Absolutely. We appreciate your information that you're sharing tonight. Wonderful. Good stuff. Good stuff. I'm looking forward to being 62 not quite there yet, but I'm getting there. Well, all right, everyone. This has been a Triangle Blockchain Development phone call tonight, and we had, of course, David Stokes, financial specialist.
Thank you,
That's
David.
absolutely-
You're welcome.
Thank you, David.
Thanks,
You're very
David.
welcome.
absolutely. And his information
Thank you.
again is in the chat window. So if you ever need to reach out to him, there's his information there. And of course, you know, he'll be around and accessible. I'm sure we'll probably have him back at another date and time with some new developments of something of some kind, I'm certain. Don't let me put words in your mouth, David. I'm
I love it, brother. No, hand me back anytime. I'm more than happy to.
Absolutely, absolutely. Well, everybody, that's going to conclude this call. All right. So we're going to say thank you and for coming out. And of course, we have our regular meetings Tuesday, the first Tuesdays of every month. All right. At 8 p.m. right here, Triangle Blockchain Development on Google Meet. So
Thank you, Blair. Thank you, Ron.
yes, you're welcome.
Right.
Good night,
Robin,
everyone.
David. All
Good
right.
night, everyone. Thank
All right,
you
y'all
so
take
much,
care.
Dave. Appreciate you. Thank you, Dave.
You're very welcome.
Thanks, good David.
Have a good night, everybody.
All right.
Thank you.
Thank
Have a
you.
great one.
Thanks.
All right.